Well, hello there, Becky.
Hi, Nick.
Hey.
Good to see you.
Great to see you as always. Literally every day. So today we're going to talk about midterm elections. It's a midterm election year.
Yeah.
A lot of people don't realize, I'm coming to find out, how there are some patterns that go on historically with the market during midterm election years and what we are likely going to be facing this year. You know, there's no guarantees of the future. You know, past performance not indicative of future results and all that. But there's some really historically relevant stuff that happens during midterms as far as the market's concerned.
I had no idea.
Well, yes, that's why I prepared our notes for the day. Yeah. Oh, yeah, I know. That's how you know it's a special day.
Buckle up, everybody.
All right. So why do midterms matter? So, of course, people are voting for their political party and all that, and that's great. But why does it matter for the market?
Yeah, tell me what happens.
Okay. So if you look at the calendar quarters of a presidential cycle, so a 4-year presidential cycle, and you look at first quarter, second quarter, third quarter, 3 of the 4 worst calendar quarters for the market occur in this year, in the midterm election year.
What?
Yeah. 3 of the 4 worst historical performing quarters.
Of the 16 quarters.
Of the 16 quarters. That's from a Fidelity study. They come out with it every year. They always show the numbers. So I just got the new updated numbers. 3 of the worst performing. The worst performing quarter.
Wow, way to start us off.
Yeah, no. So these
really uplifting fact. Okay.
Yeah. So it's hey, look, markets ebb and flow.
Yeah.
And there are always going to be down periods in the market.
Okay.
And again, not that historically, if second quarter of the midterm election year, what we're in right now is historically the worst performing quarter for the market. Doesn't mean it's always negative. Doesn't mean that. It just means historically speaking, it's the one that winds up being the worst.
Yeah, well, that kind of feels on trend for the world right now.
Yeah.
So
we got a lot going on in addition to the midterms.
There's a few things.
Yeah. So not only is this been a volatile year to start, but this also historically is the most volatile year during a normal quarter. And the most volatile quarter of that most volatile year.
Super.
Yeah.
Right in the bullseye. All right.
So why is that the case? So let's just talk about why. It's not just dumb luck.
Oh.
Right? Yeah. People, investors, companies, money managers, I always say this to people, they care more about someone being elected than who is elected.
Which is so silly because someone's going to be elected either way.
Yeah, in most cases, right? We have very, very few hanging chads and all that stuff. But,
always, but.
Yeah. But what that really says is that they care about knowing who's in office, so they have an idea of what policy is going to be.
Oh, okay.
So what's the future holds. And historically speaking, Congress is the more important part of that branch. Like, it's less relevant who the president is.
Well, it's 2/3 versus
right? Yeah,
1/3. Okay.
So normally you got to pass through Congress. Most laws, though executive orders have become a real thing the last few presidential cycles.
Yeah.
But yeah, so it becomes very relevant. So investors and firms and companies tend to tighten up.
You're just getting a tizzy.
Yeah, they're not willing to make big decisions with their money without knowing what this future policy is going to be. So it makes sense that this is a volatile period. It makes sense that the markets tend to sell off during these periods.
Everyone's just holding their breath.
Everybody's waiting, not to see what happens, but literally to see that something happens, that there's an election.
Man, humans are funny.
It's really more psychological than it is analytical, really.
Okay.
So I thought this was interesting because I share those facts with clients. They always give me that same look you just gave me. What do you mean it's more important that someone gets elected than who? And I'm like, look at history. We talked about election cycles and stuff in the past.
I believe you.
Yeah. So let's talk about historical market behavior over this period.
Yeah, let's do it. That is exactly what I want to talk about. Okay. Okay. No, really.
To have you in my life.
Historically, what's happened?
Okay. So I'm going to talk about 1930s and onward. So like modern history, basically the last 100 years.
Okay. Got it.
The market tends to struggle the first 9 to 10 months of midterm election years.
Oh, leading up to the election.
Leading up to the election.
Okay. Because everyone's needs something to happen.
They want to know what's going to happen and they're not going to make commitments. So valuations start to go down, markets start to sell off, people are sellers and not buyers, totally normal. That turns into, in real numbers, the S&P 500, our major index, experiencing on average a 17% pullback.
That's significant.
Yes. So I always use the number 20%. Just when I talk to clients, like, would I be surprised if 6 months from now the market would be down 20%? No. Now I'm just one guy, but it's historically relevant that is on average what the pullback is.
Okay. Interesting.
Okay. You look like you want some positive news.
Everybody wants positive news this year.
Here comes the positive news. So since 1938,
yeah.
So basically,
even moderner history.
By
Sorry,
8
that
years.
was bad. Okay, go ahead.
If you take the day the election happens, the midterm elections, which hasn't always been on the same.
Oh, it's the second Tuesday. It's the same, but not the same. Go ahead.
Yeah. Forward a year. And I rarely get to say this. 100% of those periods of time, 100%.
What?
The market is positive. The S&P 500
historically.
Is up. Since 1938, if you take every midterm election year, from the date of the election forward 12 months, the market has had a positive return.
Wow.
So that's pretty cool. So as for negative
that is good news.
For as negative as the first part was, we know there's a light at the end of the tunnel.
Well, we are living in unprecedented times, so let's not speak in absolutes.
Well, yes. But again, we're talking about historic information, no predictions of the future.
That's good news. All right. So people, everyone takes a breath and people get their act together.
People feel
midterms.
They get that comfort. They move on, they make their investments, and they proceed with what policy they feel is likely to occur.
That's cool.
And so people really markets hate uncertainty. They actually hate uncertainty more than bad news. People will talk about wars. Wars tend to be good for a lot of stocks, material stocks, utility stocks, manufacturing, historically speaking, because we used to literally go and build tanks and all that stuff. Yeah. Defensive stocks get really good. There's certain things that do really well when things are bad in the world. But when they're uncertain and we don't know what the future holds, that's when investors clam up and the markets are likely to go down.
I mean, that tracks. But
yeah.
Okay.
So I think that is something, as we sit here in a midterm election year, is important for people to realize that though it may only be for the next 6 months, we may not have a great period in the market. But historically speaking, immediately following that has been a phenomenally prosperous time in the market.
Okay, and this is expected.
So this is expected. So the important part here is don't be shocked if this trend continues, because we're talking about almost 100 years of data where this has been the case. Every midterm election year.
So it is likely to continue.
Correct.
Okay.
So not so bad so far?
No, I love facts.
Okay. So those were facts.
All right.
So now here comes the feelings part.
Oh, you told me to keep emotions out of it.
You should keep emotions out of it.
Okay.
But here's where with that information, right? If we can be so just confident that based on history that this is likely to occur this way, what do we do? What do we do with our money?
Yeah.
What do we do with our investments?
Yeah. If we're certain we're going to be uncertain, how do we behave?
If there's certainly going to be uncertainty, what do we do? So this is really the crux of what I want to talk about today, on the backbone of what history shows us is likely to happen in these periods. But this kind of goes for any period in the market where you see a lot of volatility, where there is a lot of uncertainty. We actually see a little bit of this in presidential election years. Very much less volatility, but some leading up to the election, and that sigh of relief, reprieve when the election's over. Yeah. But I think during any uncertain, volatile time, you have to think about, okay, what am I going to do?
Yep.
So here are what I think are the most common strategies that people choose. And I will talk about how I feel about them.
Opinions only. Okay.
Opinions only. Okay. Sell now, get back in later.
Yeah, I hear people talk about that. Just skip the whole downturn.
Yeah. Hey, if we quote unquote know, and I did air quote that for anybody listening, that the markets are going to go down, which no one knows, by the way. Even me sharing this information, it's historically what's happened, but I don't know for a fact it's going to happen.
Yeah.
But if we knew, why would we not sell?
Yeah.
Let the market sell off and buy back in. Seems obvious, right?
It seems like a strategy.
It's tempting, but it's a very dangerous option.
But we've talked about this before.
And what have you learned, Becky?
It's better just to hang in there.
And why is that?
Because you can't predict it, because it's uncertain. Anything could happen, and
Correct.
It's better to be in the game and take the hits just so you could possibly get the wins as well.
Okay.
Right?
I like that. Because I feel like when someone wants to sell anything, any investment, with the idea of buying back later.
Yeah, they're not leaving entirely.
Correct.
They just want to, okay.
It's two decision points. And you have to be correct on both of them for it to work. You have to be able to know that you're at a high and sell.
Yeah.
And then know you're at a low and buy.
And nobody knows.
And no one knows. I don't know. You don't know. No one knows. If someone
Joe
says they
know,
Joe doesn't know.
Yeah.
Bo doesn't know. Those Bo knows commercials.
Yeah. Okay.
Yeah. So that's what's really challenging. And to help illustrate that, we actually talked about this a little bit. If you miss just some of the best days that the market has in a given year, you miss like 10 of the top days.
Of the whole year. If you
miss
10 of the top days. Yeah.
10 of the top days, you cut your overall return in half. You miss like the top 15 or 20 days, you lose all of the return the S&P 500 earns in a year.
Yeah. So those two decision points
are really critical on you not missing the last little bit of the up or the first part of the recovery.
And the chances of being right on both, because you have to be right on both.
Right on both.
Is very slim. So you're saying it's better to write it out?
I would think
in your opinion,
longer term investments, absolutely.
Okay.
I mean, your shorter term investments shouldn't be taking the same kind of risk as your longer term stuff. But as we sit here today in our 40s, still accumulating, working towards retirement, there's no reason to toy around. You can stay invested, write it down, write it up. You'll be okay. Now, if you're working with a professional, financial advisor, hopefully they can use some of these other strategies to kind of dull that down a little.
Oh, okay. Tell me about those strategies.
So let's talk about those.
Possible options.
What I call getting paid to wait.
Oh, that's not a bad sounding
Sounds good, right? I really marketed that well.
Yeah.
It's basically a strategy where you focus on dividends and dividend producing investments or interest producing investments in a period of time where you expect the market to be volatile or down.
Okay.
So we'll run two things next to each other. Let's say you have a stock and they're good stocks, but if the market's down 20%, they're likely to be down 20 or 30%. Fine. When they recover, they're likely to come back up. But what if I own like some kind of like boring grandma, grandpa kind of stock? Well, when the market goes down 20%, a lot of them don't go down as much.
Oh, they're
steadier. They don't go up as much when the market goes up, but they don't go down as much.
Okay.
But what if they were producing you a 3 or 4% dividend? Means if you were in those over the course of the year, you're earning, say, a 4% dividend or cash payout to you while you're waiting for the market to get its act together.
So you're not like headlining any returns, but
you're getting some.
You're getting something.
Some return. It's not out of appreciation. It's out of dividends.
Okay. I'm going to nod along and theorize that I know the difference, but keep going.
Okay. You don't nod along. That's not what today's
about.
No.
I know what the difference
Appreciation
is.
is growth. So you buy a stock at 10, it goes to 15.
And dividends are actually paying out to you.
Cash that's paid out.
And you can reinvest.
Correct. So if you're retired, you could take those dividends as cash, use them as your income, have them direct deposit in your account.
Okay.
If you're still accumulating or some of this money is for accumulation, you can do what you just said. You take that cash, they rebuy new shares. So not only are you earning something while maybe the market's going down, if you're buying new shares, you're actually buying them at a discount. As it goes down, as it comes back up and recovers. And by the time the market breaks even, you will actually be net positive because you will have more shares than you had when the market started selling off.
Oh, interesting.
At the same price, which means you'll have a higher total value.
And a financial professional could help you navigate
identify those.
Yeah. Okay.
Throw on top that there are investments today that are, of course, a little more complicated than, say, a traditional stock paying a dividend, but are heavily focused on dividend first strategies. And they're based on the market being volatile. So, for example, there's strategies we're using with clients now that are paying 7, 8, 9% dividends annually.
What?
Yeah.
That's cool.
To hold a basket of stocks. But because they're using option strategies and all this complex stuff underneath, but they're now readily available to retail investors. So why not own a more conservative basket of stocks instead of your aggressive growth ones and get paid 7 or 8% is insane.
That's good.
It's arguably not sustainable. But right now, while volatility is really high, these are paying a really high income.
Yeah.
So you do that for now.
It could be considered a good option to calm the volatility.
Correct.
Okay.
So one important thing is what you just said.
Mm-hmm.
That'll dull down the swings.
Mm-hmm.
But secondly, you stay invested. So like our first strategy, which was sell and go away and come back later, there's no timing involved or very little timing.
Mm-hmm.
So if
this second strategy.
If you like lean a little more towards dividends and then the market bottoms and starts to recover, you have plenty of time. You don't have to nail the bottom.
Yeah.
You could just then start moving back into more growth oriented things if that's what you want, but you're invested the whole time. So if you fell asleep for a year, you would still be making money as the market went up, presumably, regardless of what stocks you own.
Nice.
Yeah. So I like that strategy a lot.
Yeah.
All right. So far, so good?
So far, so good.
Okay. Strategy number 3.
Hit me.
My favorite strategy that I'm amazed advisors have not taken to more often.
Oh, we're going to share the secret sauce here?
I'm very open about this. I talk every call I'm on, every coaching call, everything I do with advisors, I ask them if they're using buffered or downside protected investments.
Oh.
For years, that meant an annuity, something that was principal protected, like a CD.
Yeah.
Can't lose money, but you make very little on the way up. There have been buffered equity, like stock investments for better of 10 plus years now that I've been using with clients.
Wow.
In general, they are tracking an index like an S&P 500, but imagine you can be in the market, get 100% of what the market earns up to say, 13 to 15%
hypothetically
in a year, hypothetically. But if the market's down over a year, the first 15% of your losses are protected.
Could be protected. Hey, that sounds really nice.
So I like that as another strategy that says I can stay invested.
Yeah.
But I'm protecting against more losses.
You got shin guards and water wings and everything else.
Exactly. I'm not like naked out there. I have a little bubble wrap around me. And what I wind up doing with clients is I use those last two. I use a combination of high dividend producing and buffered protected strategies. And if there's something dramatic that happens, we may trim off some gains.
You could feel it.
And have a little bit of extra cash, but we're not using that to try and time the market. We're using these strategies to keep us invested, let us benefit from the market doing well, because I may think this is the direction the market's going, but if I'm invested in these and I'm wrong and the market goes up, my clients still are participating in the market.
That's really cool.
I'm not trying to get them out of it. So those are some strategies that people I think should acknowledge exist, be aware of with that information.
And talk to their financial advisor.
Yeah, I'll absolutely talk to your financial advisor.
That sounds great.
So I think in a summary sense, expect the volatility. Do not fear it. I think people get scared of it and they want to get away.
And they make quick decisions.
And those people, I can't tell you, I know it's a little dated of a reference, but during the financial crisis of 2008, I can't tell you how many clients I met in 2011, 2012, 2013 that had still not gotten back into the market.
Oh my gosh, they missed years of investing?
Years, because they lost all the money in 2008. It scared them and they just went away and they didn't know when to get back.
Don't let fear.
So don't let fear drive you.
Yeah.
I like the idea of staying invested, but be smart about how you do it.
Yeah.
If you're worried the market's going to sell off, maybe don't own the most speculative, big win, scratch off ticket kind of stocks. Maybe look for dividends for income, look for buffers for protection, look for maybe more conservative style holdings. Avoid all the emotion decisions. We talked about emotions right off the bat.
Yeah.
Market timing is seductive. It is destructive though.
Oh, seductive but destructive.
I know you like a good rhyme.
Whoa.
And missing the best days that the market has is actually more damaging than avoiding the worst days.
Listen to this. These are big power
I told you,
hitters right here.
I prepared for today's.
You're going to make my fun fact look bad.
Oh, okay.
It's not that great anyway, but keep going. I know. I'm tempting.
Midterm years are rough. Historically, the year after midterm elections are very strong for the market. But usually this 9-10 months of the year leading up to it is bad. That is all of my facts, all of my deets, all of my summary. Bing, bang, boom. Call me Sally.
Okay. So I was trying to come up with a fun fact, and all you told me we were talking about was midterm elections.
Yeah.
So mine has less to do with the market and more to do with midterm elections.
I don't think people are listening to you for market analysis.
Thank goodness.
Yeah.
Nobody should. Okay.
What fun fact do you have for us today?
Which U.S. president
What's the question?
Suffered the greatest loss in a midterm election, meaning had the biggest party change in the Senate and the House?
Is it modern?
No, it's from the 1800s.
Oh, Jesus.
So give me an 1800s president.
Adams.
No. The distinction belongs to President Grover Cleveland.
Ah,
good old Grover. Who lost 116 seats in the House.
Jeez.
And 4 Senate seats in the 1894 midterms.
Ooh.
Okay, and also, just as a fun fact, Grover Cleveland is also the only other president besides the current President Trump who was elected to non-consecutive terms.
I knew that fact. Yeah.
There was a lot that was going on. You can read about it, but basically, there was a downturn in the economy, and people were not happy, and
they just gutted Congress.
There were a lot of similar words, actually, like tariffs and stuff like that surround that downturn. But he lost 116 seats in the House in midterms.
That is a jarring amount of seats.
Yeah.
I mean, and we talk about congressional term limits and things that I think a lot of people agree, like at some point, like get out of there, let some new blood in. That's one way to do it. Just don't reelect
for his whole party. Yeah. So anyway,
that's a fun fact, but not for Grover Cleveland.
Yeah.
I don't think he cares anymore.
I will say it is related to the market because people were affected in their economically, and they voted in response to that, and that's what happened. Wow. So anyway.
So
we'll see what happens this year in 2026.
And there's a lot of talk about it on which way it might go and who may win more seats. And I think it'll be pretty close.
And there's a few things going on in the world that may influence it.
Yeah, I mean, there's some geopolitical things going on. And I think that adds to kind of this overall strategy concept. It doesn't just need to be midterms. If there is pressure building and there's a lot of uncertainty, the markets would rather something bad happen than have an a definitive bad thing, and that includes policy, taxes.
Yeah, I've never thought of it that way, but it makes sense.
Yeah.
So
the markets are a fickle beast. People always try to relate the economy to the market or the market to what's going on in the world. And like when, and there's wars all over the place and all this stuff. And a lot of times I'm the person that goes, yeah, the market's not going to care about that. Apple's still making iPhones. But when things like tariffs happen, when there's a lot of geopolitical things, now we're in a midterm, so policy may be changing. All of a sudden now the market's tensing up, and I can feel it. And so we're making wholesale changes. We have been since the beginning of the year for clients. So my clients that are listening, don't worry. We're doing these kinds of strategies for you. But I think it's important for people to know the difference between I don't like our current political environment and what the market is likely to do based on that information in those volatile times. So that wasn't too bad of a fun fact.
Well, thanks.
Yeah. But I think there's some really historically relevant stuff that
for sure.
It's the old history doesn't repeat itself, but it rhymes. This feels very familiar. It's very relevant. And I think people should be thinking about it and assessing their portfolios. Again, don't panic. Don't let fear or emotion drive you.
Yeah.
Be aware, use that knowledge and those facts as your power to be able to make decisions and changes
in your best interest. Yeah.
And if you're arguably our age or younger, you could close your eyes, plug your nose, hold your breath,
fall asleep for a year.
Ride the market down, ride the market back up. It's fine. But anybody that wants to have a little more
play in the game.
Yeah, a little more umph. I think these are things that come up.
Well, thanks, Nick.
Well, thank you, Becky. It's about once every 20 episodes that I prep all the show notes. So we might as well appreciate it when it happens. But thank you.
Yeah.
If anybody has any questions, as I'm sure you will have once we get off camera, she always waits for all the really good questions until we're done recording. Find us on the website, sunrisewealthadvisors.com. We're on all the social medias. Feel free, shoot a message. We have a little chat box there. If you have any questions or need anything, we are here for you. Best of luck, and we'll see you next time.
Have a good one, everybody.
Thank you for listening to the Can I Retire Now podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.sunrisewealthadvisors.com or give us a call at 407-351-3476. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Can I Retire Now? The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The views depicted in this material are for informational purposes only and not necessarily those of Cetera Advisors. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors nor any of its representatives may give legal or tax advice. Securities and advisory services offered through Cetera Advisors, LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. 6052 Turkey Lake Road, Suite 101, Orlando, Florida, 32819.
All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Past performance is not an indication or guarantee of future results. The hypothetical investment results are for illustrative purposes only and should not be deemed a representation of past or future results. Actual investment results may be more or less than those shown. This does not represent any specific product. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing.